families as we all work to get our economy back on track. At a time when far too many 5th District Virginians and Americans remain out of work, we must continue to support policies that will help restore certainty to the marketplace, grow the economy, and create jobs. I urge the body to pass this bill, and I thank the gentlelady. I yield back.
Time has expired.
My time.
Appreciate your recognition. Gentleman from Massachusetts.
I yield to the chair, former and now ranking member of the Small Business Committee, and we've heard talk about small business. Here's the best protector of small business in the Congress, a gentleman from New York, for 2.5 minutes.
Gentlelady is recognized for 2.5 minutes.
Thank you, Ranking Member Frank, for your commitment and your balanced approach to protect consumers in this country. Mr. Chairman, I rise in strong opposition to H.R. 1315. My first question is, do my colleagues on the other side of the aisle really have that short a memory? It was just 3 years ago when regulator indifference resulted in the single largest loss of middle-class prosperity in this nation's history, costing over $3 trillion in this country. In fact, we have spent the last month debating the need to raise the debt, not because of the war in Iraq, not the stimulus plan, but because of the massive bailout needed as a result of regulators turning a blind eye to unfair and unsafe lending practices. You can go to any community in any part of this country and see the collateral damage resulting from Wall Street playing fast and loose under the disinterested watch of federal regulation. In Brooklyn, 1 in 8 mortgages are in serious delinquency or foreclosure. It was this type of dire situation that our working families were left with that necessitated, demanded that we act and create the CFPB. By consolidating all financial protection within the umbrella of CFPB, every American is given the peace of mind that someone is watching out for their interests, not some financial institution's bottom line. Unfortunately, the legislation before us today will create a completely unmanageable regulatory process, once again leaving the average American in financial limbo. I am not willing to go back to those days, and neither are the 200,000 seniors in New York City who will be without protections should this legislation pass. Vote no on this bill. Let's not allow the very regulator that stood by and did nothing while trillions were stolen from Americans do nothing again. I yield back.
Gentlelady from West Virginia.
Thank you. I would like to remind the other side that we're not taking any powers away from the CFPB. We're not reforming any of the reach of the CFPB. We're simply looking at the accountability structure of who's going to be governing the CFPB. And the gentlewoman from New York was very helpful in committee when we amended the commission to have one commissioner, particularly looking at specialty issues concerning veterans and elderly and children. And I thank her for her input on that. And I'd like to recognize the gentleman from New York, a great member of our committee, Mr. Grimm, for 1.5 minutes.
Gentleman recognized for 1.5 minutes.
Thank you, Chairman. I thank the gentlewoman for yielding. I'm almost at a loss for words when I hear that we're taking away the protections for our seniors, that we're weakening this and we're weakening that. This is simply a common-sense approach to reforming the CFPB and correcting the bureaucratic overreach from Dodd-Frank. Specifically, this bill very, very simply replaces a single director model with a 5-member bipartisan commission. A bipartisan commission. That's what this bill is doing. A commission has several advantages over a single director. For example, a commission will drastically decrease uncertainty over the rules issued by the CFPB. As the Bureau is currently structured, a new director can ultimately reverse a decision of his or her predecessors. Such dictatorial power will do nothing but increase uncertainty in our markets and reduce credit access to businesses and consumers, and that stifles job growth. Today, we have unemployment at 9.2%. We must stop the job-killing, economy-crushing policies that have come out of Washington. And that's why I urge my colleague to support H.R. 1315, and I yield back.
The gentleman yields back. The gentleman from Massachusetts.
First, I yield myself 30 seconds to say I understand many of the Republicans objected to the financial reform bill. It was too long. But apparently an even much shorter bill was too long. The gentleman from New York, he got up and talked about this bill and then mentioned one-third of it. That's only one-third of the bill, which he talks about as if it was the whole bill. It goes forward to give the bank regulators the power to overturn the Consumer Bureau. It delays the takeover of some of the powers. So when a member can't get through a 4- or 5-page bill, I understand why they are confused by something that is more complex. And I now yield 2 minutes to the gentleman from Michigan.
The gentleman is recognized for 2 minutes.
I'd like to thank the gentleman from Massachusetts for yielding for his leadership on this issue. Mr. Chairman, imagine a wave of arson attacks was burning down houses and businesses across the city. Then imagine that the City Council responded by trying to delay and water down new laws making arson a crime, refused to appoint a police and fire chief, and gutted funding for public safety. Well, I know that sounds far-fetched, but that's exactly what the Republican majority is doing in the aftermath of the 2008 financial crisis. It was everyday American consumers who suffered most from the financial crisis through job losses, foreclosures, declining home values, and decimated retirement accounts. The Dodd-Frank Wall Street Reform and Consumer Protection Act was designed to address fundamental weaknesses in the financial regulations that keep our economy safe. The centerpiece of this law is the Consumer Financial Protection Bureau, a new agency tasked with putting consumers first, not Wall Street or other special interest. The bills we are debating today are part of a coordinated effort by the Republicans to let Wall Street go back to business as usual. They have been trying to delay the implementation of these new rules. They have been gutting funding for the agencies that are supposed to be the cops on the Wall Street beat, and they are refusing to allow qualified nominees to even be considered for appointments. This bill is called the Consumer Financial Protection Bureau Improvement Act, but it has nothing to do with improving the agency. This bill would make it easier for special interests to block or delay CFPB rules. The American people are sick and tired of gridlock, yet this bill only offers more of the same. In the example above, the fires breaking out across town, ask yourself, Mr. Speaker, who would you blame after the next building burned? Would it be the understaffed police who failed to catch the arsonist, or the ill-equipped firefighters who failed to put out the fire, or would the responsibility lie with the politicians who failed to give them the tools that they need in order to do their jobs? I urge my colleagues to stand with consumers and oppose this legislation. We need to make sure the law takes effect and keep fighting to implement the reforms needed.
The gentleman's time has expired.
I yield back.
The gentleman's time has expired. Gentlelady from West Virginia.
Thank you, Mr. Chairman. I would like to recognize Mr. Garrett of New Jersey, a member of our committee and a chairman of the Capital Markets Subcommittee, for 2 minutes.
The gentleman is recognized for 2 minutes.
And I thank the Chair, and I congratulate the good work done by the Chairman of the full committee and the Chairman of the subcommittee and the gentleman from Wisconsin for a common sense piece of legislation before us. Earlier I heard the ranking member from Massachusetts comment about the partisanship of here, and he said something like, well, we didn't make this partisan, they did it. Well, I remind the Chairman that his underlying piece of legislation, the Dodd-Frank piece of legislation, actually had more Democrats vote against it than it had Republicans for it. And he was the one that actually pushed through a bill in an extremely partisan manner, and that's really why we're here today. You know, I believe that the agency we're talking about, the CFPB, is really a one-stop shop to basically allocate credit and give the government the power to direct and control the economy. And at the same time they're talking about consumer protection, what are they doing? They're separating safety and soundness from it. How can you have consumer protection when you're separating safety and soundness? I also remind the ranking member, who originally was the sponsor of Dodd-Frank, the bill that has his name on it, that bill that is going to destroy so many jobs in this country, that he, as pointed out once before, that he was in favor of the same type of legislation that we have before us today on the floor. So basically this is once again a case of where the ranking member was in favor of it before he was against it. Not at this time. So operating under that logic, we are hearing from the other side, if the bill today weakens the agency, then the bill that you introduced originally, the gentleman introduced originally, would actually destroy the agency. Now, I've heard the ranking member during his debates do what he always does. When he doesn't have the facts or the law on his side, he attacks and he twists other people's motives. He knows that he was essentially supported the elements of this bill today by offering these provisions himself before to get through the House, but today he comes out against it. Basically, he accuses everyone on our side of the aisle of trying to kill his legislation, but might I again remind him to consider his own statements. The ranking member has claimed over this past week that the most important piece of the Dodd-Frank bill is the risk retention section of the legislation. Then he turns around and says,
how much time do I have remaining?
Yeah, 4.5 minutes.
4.5 minutes?
And the gentleman from Massachusetts has
I'll yield
15 seconds.
another 30 seconds. The gentleman from New
Gentleman's
Jersey.
recognized, 30 seconds.
so he says on the one hand that the risk retention is most important. Then he turns around and says that any loans with 4% down payment should be exempt from risk retention. I don't know very many loans that are at that level. So I find it surprising that he is attempting to exempt everyone from what he claims is the most important portion of his bill, instead of accusing everyone else of attempting to destroy this job-destroying bill. Mr. Speaker, I would ask that the gentleman from Massachusetts should think before he speaks on this legislation and then come out and support the same type of legislation that he once supported in the past.
Gentleman's time has expired. Gentleman from Massachusetts.
How much time is remaining, Mr. Chairman?
Gentlelady from West Virginia has 4 minutes. The gentleman from Massachusetts has 5 3/4 minutes.
I am my final speaker, so I
have no further speakers. I have no further speakers.
So, well, I assume the gentlewoman, yes. Then I will use my time. First, the gentleman from New Jersey more consistently misstates things that I said. I suppose it's kind of flattering that he hangs on my every word. I just wish that he didn't hang askew on my every word. He said I should be supporting this legislation, and in fact the gentleman from Alabama said it. Once again, listen to what they say on the other side. This has 3 pieces. It has a single member versus a commission. More importantly, it increases the ability of the other bank regulators who have an historic terrible record of consumer protection, who the chairman of the committee, Mr. Backus, says are there to serve the banks. It would put them in a better position to cancel the work of the CFPB. So the gentleman from New Jersey said, I've supported this. I've never supported anything remotely like that. The gentleman from New Jersey knows that. I have no idea why he would do that, except for this. And yes, I will impute some motive. Of the 3 parts of the bill, the only one that they think won't be very unpopular is the one about a single chairman versus a single director versus a commission. But again, the gentleman said, oh, I misstated that, because, or that I was in favor of something last year. No, I was never in favor of those parts of the bill. By the way, as to the risk retention, I did say you could get to 4% if you also had a very good debt-to-income ratio and loan-to-value ratio. So the pattern of misstatements of what I said it's flattering that the gentleman is so interested in what I say. No, just as the gentleman wouldn't yield to me, I won't yield to him. I don't understand why he doesn't understand reciprocity. The point is...
Well, just because I thought you want to answer the question.
Mr. Chairman, I asked the gentleman to observe the rules. I asked him to yield. He wouldn't yield. He's now complaining I won't yield to him. Typical, I think, of a certain pattern of behavior. Mr. Chairman, I ask for regular order.
Regular order.
I did not ever support putting the bank regulators back in charge. And in fact, I will say this about the gentleman from New Jersey. He's more clear about what he really believes. Again, I hope the gentleman from West Virginia, when she closes, will tell us she voted against this last year. She now says, oh, we're not trying to undo it. Well, has she switched her position? The gentleman from New Jersey was very clear. He doesn't really like this. And he voted against it, and he would abolish the whole thing. And that's what we are saying, that people who voted against it last year, and he says, we made it partisan? No. When the vote came on this, they all voted against it. I wish that wasn't the case. But they had voted against it because they didn't want an independent consumer agency. The chairman of the committee said it again today on television. We don't worry about the FDIC or the Federal Reserve. We worry about an agency whose sole mission is to protect the consumer without worrying about how the banks work. And then we had the performance by the gentleman from Wisconsin, again, talking only about one part of it, and claiming, oddly, it seemed to me, that this somehow hurts the smaller banks versus the bigger banks. In fact, the smaller banks are given preference with regard to who gets examined. And in terms of the ability to overturn rules, no, it's not simply, and this is one of the things some people may misunderstand, things that threaten the system might be the action of one particular entity like AIG, but they could also be a pattern like subprime loans, particularly subprime loans issued by non-banks. And this bill covers, regulates for the first time those non-banks. So let's go back over this. Ms. Warren came up with the idea, and I do want to address the single member versus commission. Is the one issue they have found. It was originally proposed by Ms. Warren, and I introduced the administration bill to make it a commission. We had hearings. We had conversations. And every single consumer group that we dealt with, the gentleman from Wisconsin mentioned all his supporters. There wasn't a single consumer group there. The ARP just came out against their bill, as have all the consumer groups, the Consumer Federation, etc. They persuaded me that a single member would be better than a commission. I acknowledge we had hearings. I listened to people who were for it. So here's the debate. We have everybody who voted against establishing this in the first place, who are against it in principle, who think we should leave it to the bank regulators. They want a commission. We have everybody who supports the entity as an independent consumer protector, therefore a single member. I listened, I was persuaded. So yes, I will acknowledge having changed my position based on the evidence. I will repudiate once again the gentleman's inaccurate suggestion that I was for the other parts of this. No, I was not. And I think putting the bank regulators, the majority of the bank regulators able to overrule virtually anything doesn't work. And the proof of that, the Republicans offered their own version last year, the gentleman from Illinois, Ms. Bigger. It created a 14-member council, Secretary of Treasury, Secretary of Defense, a bunch of others, and they were empowered to set up a hotline. And if they got things from the hotline or the website that were complaints about the banks, what did they do with them? They sent them to the very financial regulators who have failed to do things in the past. That's where we are. That's what they preferred. They opposed then, and I believe continue to oppose, an independent regulator whose primary role is the consumer. As the gentleman from North Carolina pointed out, they want to give the FDIC and the other bank regulators the ability to cancel what the consumer regulator does, but it's not reciprocal. If the consumer regulator thinks that the bank regulators have been too lax in not protecting consumers and what they still have, that's not reciprocal. It is very clear. They have never liked consumer protection. And finally, Mr. Chairman, I want to say that they do the banks a disservice. And I stress again that the banks were not the problems here, particularly the community banks, the credit unions.
Gentleman's time has expired.
They apparently think that if banks have to protect consumers, they will fail.
The gentleman's
That's
time
unfair
has
to the banks.
expired. The gentleman's time has expired. The gentlelady from West Virginia is recognized for 4 minutes.
Thank you, Mr. Chairman. I would like to make a few points in closing. First of all, I want everyone to understand that nothing in this package weakens or changes the ability of the CFPB to make rules and regulations for consumer protection. Now, the ranking member was criticizing me for trying to change something that I didn't support. Well, guess what? I'm a realist. I see this is law. This is now a part of our government. And my chore is to try to make it better. If I wanted to get rid of it, I'd be sitting here arguing for a bill that totally dismantled the entire Bureau. But I'm not doing that, and neither are my colleagues. Because we accept the reality that the Bureau is going to exist, and we want to see it exist in the best form. And that's why we're trying to make changes to it. We can argue back and forth about whether a commission or an individual director is better or not. We believe a commission is better. Their original bill stated that. And there are others on the other side of this building who believe that to be true as well, to mirror some of the other regulatory bodies that we have in the financial arena and other arenas. I find it a little bit amusing that, and the ranking member keeps saying, well, you're only talking about one section. So let's talk about the other section, the ability to overturn a rule that's been promulgated by the director of the CFPB. He says we're trying to make it so that those rules can be overturned. Well, guess what? His bill makes makes you able to overturn the rules. He voted yes on that, and so did everybody else who voted for this bill. So the concept of overturning a rule and a regulation is reality. It's already in the bill. We're simply saying if you're going to have a rule that says you can overturn a rule and a regulation or a law that says that, let's make it workable. Their standard is the whole safety and soundness of the entire financial system. Please. I mean, what rule could possibly do that? I'm sure there's one out there, but I'm not sure what it is. And so we've got to get over some of the over-exaggerations of what we're trying to do here today. And the last part of the bill is actually my bill. And that is saying that I don't think that we should be turning over the reins of the CFPB to a single person. Number one, I don't agree with that. But if I accept reality, remember I said I'm accepting reality. If it is one person, like it's written, then let's make sure that the intent of that is a Senate-confirmed person. That's the way it's written in the law. It's a Senate confirmation. And I'm saying in my part of the bill, I don't like the fact that we're going to throw everything into this bureau and have somebody who's not Senate confirmed overlook this, and then we don't have the oversight that we have as members of this Congress. Those are the three sections of this bill. But none of the provisions that we're talking about destroys consumers' ability to be looked after by this Bureau. None of this bill undoes any of the Bureau's ability to undo deceptive and abusive practices. We certainly think that, you know, that's a laudable goal. We don't like the way it's maybe been constructed, but we lost that fight. The reality is this Bureau is here. And so let's make it better. Let's make it better for the consumers, because this is who we're talking about. I've had strings of people in my district before our committee saying we can't hire people because there's too much uncertainty. There's a regulatory structure here in the financial institutions that we don't understand. We don't understand what it is. We don't understand what it's going to mean, and it's constraining our ability to help small business owners, and that's constraining our ability to grow jobs in this country. And so that's what we're talking about today. We're talking about getting back up on our feet, weeding through this bureaucracy, and making sure that the financial institutions that are heart and soul of this country can grow the jobs, grow the economy, and get people back to work.
Time has expired.
Thank you.
All time of general debate has expired. Pursuant to the rule, the bill will be considered for amendment under the 5-minute rule. In lieu of the amendment and the nature of the substitute recommended by the Committee on Financial Services printed in the bill, it shall be in order to consider as an original bill for the purpose of amendment under the 5-minute rule, an amendment in the nature of a substitute consisting of the text of the Rules Committee print dated July 14, 2011. That amendment shall be considered read. No amendment to the amendment in the nature of a substitute shall be in order except those printed in House Report 112-172. Each amendment may be offered only in the order printed in the report by a member designated in the report, shall be considered read, shall be debatable for the time specified in the report, equally divided and controlled by the proponent and an opponent, shall not be subject to amendment, and shall not be subject to demand for division of the question. It is now in order to consider amendment number 1, printed in the House Report 112-172. The Ellison of Minnesota amendment. Present. Gentlewoman from New York, seek recognition.
I have an amendment at the desk on behalf of the gentleman from Minnesota, Mr. Ellison, who is recovering from knee injury.
Report the amendment.
Amendment number 1, printed in House Report number 112-172, offered by Mrs. Maloney of New York.
And I ask unanimous consent that the reading be dispensed with.
Without objection.
Okay.
Pursuant to House Resolution 358, the gentlewoman from New York, Maloney, and a member of each side shall control 5 minutes. The chair recognizes the gentlelady from New York.
Okay, you want to get the charts up here? Okay. Thank you. Today is the 1-year anniversary of Dodd-Frank, and it's also the date of transferring authority to the CFPB so it can protect consumers in one single place. The Consumer Financial Protection Bureau is a critical part of last year's financial reform bill. It will ensure that there is a cop on the beat protecting consumers from predatory products and misleading information. But instead of supporting the CFPB on its first day, the House Republicans are pushing forward with a bill to weaken this important agency, to derail, delay, and defang it. And I want to point out that many of the people on the other side of the aisle that are supporting the Republican change are the exact same ones that voted against Dodd-Frank in the first place, opposed the consumer protections, and opposed the creation of the CFPB. I would say that the bill sets out to change the CFPB so that it is less independent and instead is more bureaucratic. The House Republicans want a 5-person commission instead of a single director. But the single director structure is exactly like the OCC, the OTS, and other financial agencies. And a single director promotes more accountability, allows quicker reaction and change to market conditions. And a 5-person board would be slow, indecisive, and more expensive. Now, the Office of Management and Budget estimates that this new form will cost $71 million. And where do they propose to get this money? From a program that was helping consumers who lost their mortgages were underwater. But if we had had a CFPB in place, we could have prevented the subprime crisis in the first place. One of the problems is that no one in the whole regulatory structure was looking out for consumers. Consumers were an afterthought, a third thought, or were not thought about at all. And this agency will be the first time that someone is looking out for the consumer. Now, they also want to make it easier for bank regulators to override the CFPB rules so that they can go back to the status quo that led up to the financial crisis in the first place, that has cost the American public trillions and trillions of dollars. The Ellison Amendment would delete the section of Dodd-Frank that created the FSOC override. The other body included it as a way to provide a check on a single director, but if they're going to change the entire structure to a 5-person commission, then there is no need for that additional check. And the override power of the FSOC would be entirely eliminated. So I ask my colleagues to support the Ellison Amendment. But most importantly, Americans favor a strong CFPB. In a poll this last week, it showed that 73% favor a strong and independent CFPB protecting consumers. And as the chart behind me shows, they overwhelmingly support the critical functions of the Bureau, including better disclosure for credit cards, making it easier for lenders to offer loans making it harder for them to offer loans that are confusing, with confusing teaser rates and other features, allowing them to come forward with simplified forms so that they could compare prices and get the best price and product for them. It would make risk clear and prices clear. My colleagues on the other side of the aisle are doing everything they can to defang and delay it. I now yield my remaining time to the gentleman from the great state of North Carolina.
If I may inquire how much time does remain.
So that's 45 seconds.
Thank you, Mr. Chairman. I know that the Republicans' political consultants have said that they need to argue, because Americans really do like this agency, that it's huge, has dictatorial powers, unchecked, no accountability. The problem with that argument is it is completely untrue. This agency has all of the oversight and more that every other agency has. Before they adopt a rule, they have to let everyone know they're thinking about adopting a rule. They have to take public comment. Then they have to propose the rule. Then they have to take more public comment. And then after all that, they can be taken to court. And if the rule is arbitrary and capricious or there's no evidence to support it, it can be turned over by court. There is ample protection in the rule, in the law already. We do not need the additional check of having the regulators, the supposed watchdogs who did such an abysmal job in the last decade, having a veto over everything they do. There are protections enough already.
The gentleman's time has expired. Gentlelady from West Virginia.
Mr. Chairman, I claim time in opposition.
The gentlewoman is recognized for 5 minutes.
Well, I would like to just start by saying I'm absolutely sort of amazed at this amendment, and that my ranking member is in favor of this amendment, considering that she voted for the bill and she's voting to strike the section of the oversight of the FSOC that that she and others who wrote the bill put in there, because that's basically what this amendment does. But I'd like to yield the remainder of my time to Mr. Duffy of Wisconsin.
Thank you.
Gentleman is recognized.
Thank you, Mr. Chairman. I think it's important to note probably the root reason why oversight of the CFPB was included in the original legislation. That is, the CFPB doesn't have to consider safety and soundness when they're making rules. I mean, safety and soundness is the gold standard when we look at our banking industry and how it effectively works within our society. And because that is not included, we just look at consumer protection, I think the rationale was that, well, we should have an outside group review each rule that comes out to make sure it will not undermine our financial sector. I have to tell you, I'm quite amazed, though. My friends across the aisle, they draft a bill that includes a review process that only gives a voice to big banks on Wall Street, only gives a voice to those banks that are too big to fail. And so I come out with a common sense reform, and I say, listen, let's just not give a voice to your friends on Wall Street. Let's give a voice to the small community banks in rural Wisconsin, small credit unions in rural Wisconsin. Let's give them a voice too. And when we do that, when we make that proposal, Mr. Chairman, it seems like they want to take their ball and go home and say, well, if you want to give a voice to small community banks, then no one should have a voice to express their concern for a rule that could be harmful. I mean, when you look at small community banks that are already overregulated, small community banks and credit unions who had nothing to do with the financial crisis but are going to be stuck dealing with over 2,000 pages of rules from Dodd-Frank, let's give them a voice to come here and say this is how these rules will impact and affect us. And so I would say to my friends across the aisle, don't take your ball and go home. Let's actually work together and find a way where we can give a voice to those banks and those credit unions who don't currently have one. With that, I yield back to the Madam Chairwoman.
I yield back the balance of my time.
Gentlelady is back. The question is on the amendment offered by the gentlewoman from New York. All those in favor say aye. All those in favor say no. Permitting the chair, the noes have it. The amendment is not agreed to. It is now in order to consider Amendment Number 2, printed in House Report 112-172. For what purpose does the gentlewoman from Texas seek recognition? Gentlewoman, the clerk will designate the amendment.
Amendment Number 2, printed in House Report Number 112-172, offered by Ms. Jackson Lee of Texas.
Pursuant to House Resolution 358, the gentlewoman from Texas, Ms. Jackson Lee, and a member opposed shall each control 5 minutes. The chair recognizes the gentlewoman from Texas.
I thank the chairman. I thank Mr. Frank, and I thank the ranking member. I thank the managers of this legislation as well. I have become friends with my two poster pictures here because I do think they symbolize sort of the composite of America. And my amendment, of course, I think focuses on making sure that the Consumer Financial Protection Bureau, something that consumers ask for. You know, sometimes under the Christmas tree or during the gift-giving season, you get a gift that you may not have asked for, but you know there's a problem or you know you want something, and all of a sudden that gift shows up. That's what the Dodd-Frank bill did with the Consumer Financial Protection Bureau. Now my friends want to defang, derail, and delay this very important legislation. The Bureau was created, and it is one of the strongest provisions of the Dodd-Frank bill, and it was created to consolidate the authorities responsible for consumer protection. It is an important bill because American consumers, you need to have strong protection. Credit cards, buying a car, student loans. We're not trying to undermine businesses. We're simply trying to create an even playing field. My amendment empowers the Consumer Board and ensures that it will be able to issue the rules that will protect the average financial consumer. The bill that we're speaking of, as written, empowers the Financial Stability Oversight Council to overrule. So you get a victory, they come and overrule it. This will literally turn it around. My bill restores a two-thirds responsibility or the two-thirds vote that is needed to overrule a good vote for the consumers, a good vote for this nurse who may be buying a car, a good vote for this little one whose parents may be overburdened with credit card debt because they signed on to credit cards with enormous interest rates of which they are unaware of. Or it may be able to help these military families, many of them suffering because of the sons and daughters, husbands and wives who are overseas, and to be able to say to these families, you can get a home without being defrauded. And so I ask my colleagues to support this amendment, and I reserve my time.
Gentlelady, can she reserve?
I reserve my time.
Time. Gentlelady reserves her time. Gentlelady from West Virginia.
Mr. Chairman, I rise to claim the time in opposition.
Gentlelady is recognized for 5 minutes.
Thank you. I oppose the bill because I oppose the amendment because I'm in support of the bill, Mr. Duffy's bill, which puts a workable and a more reasonable standard that could actually look at consumer rules and regulations that, as he has said, and I think very eloquently, takes into consideration Main Street, the community bankers, the credit unions. I would like to remind the gentlewoman from Texas, as we were reminded from the gentleman from Massachusetts, that car loans are exempted from this. So we don't have to worry about car loans in terms of being part of a rule and regulation. That is part of the Dodd-Frank bill. But anyway, I think that a simple majority makes a lot of sense, and I would just yield 2 minutes to the gentleman from Wisconsin.
Gentleman is recognized for 2 minutes.
Thank you. And I think one of the reasons, well, I know one of the reasons why we modified the rule, because right now with the two-thirds majority, you basically need 7 out of 10 votes to overturn what would be a harmful rule. And the way the law is currently written, one of the voting members is the director of the CFPB, making the standard that much more difficult. If we're talking about harmful rules to our community banks and our credit unions, let's make sure we have a simple majority that can step in and overturn those rules. Why do we want to set a standard so high that it can't be overturned? It's nearly impossible to overturn it. And I would commend my friends on the other side of the aisle to make sure there was a review process in the CFPB. But with that, no law is ever perfect. And with that, I think we should come forward today and say, how can we better perfect this rule to work for our consumers? And having a simple majority to overturn a rule that could be harmful coming from the CFPB does exactly that. I would yield back.
Gentleman yields back. Gentlelady from Texas.
Let me just say, as I yield to the gentleman, the ranking member and chairman, at the time of the passage of this bill, I was given a litany of ills that can attack consumers. I'm glad we have this board, and I'm glad that we are looking to restore the two-thirds oversight to protect these individuals and the nurse and the child. I yield the balance of my time to Mr. Frank. I ask your support for the amendment. I yield to Mr. Frank.
I thank the gentleman. First of all, let's resolve one contradiction in the Republican amendment. Some have said, oh, why are you now opposing what you originally supported? Well, this is a clear example. We never supported anything like this. We always thought it had to be two-thirds. And here's what happened. There is no comparable banking agency which can be overruled by the other agencies. But the Republicans got very nervous about this, and their banker friends were in a bit of a twitter. And they said, save us from this horrible notion of consumer protection. I say it doesn't speak well for banks that they think consumer protection undermines safety and soundness. So we said, okay, here's what we'll do. To reassure these fears, we will say that if it does threaten the whole system, two-thirds can overturn it. We didn't think that was very likely. It was to try to calm people down. They transform it with this amendment into saying that 5 regulators, because the Consumer Bureau couldn't vote, 5 regulators who have overlapping terms, who may have been appointed by previous presidents, regulators who represent the very regulatory agencies that have not been good about consumers can overturn the Consumer Bureau. This amendment cancels the fundamental reason for having a Consumer Bureau. It's one thing to say that in an extreme case, to keep your banker friends from getting upset, they can do it, but not as a regular order of business.
Gentleman's time has expired. Gentlelady from West Virginia has 3 minutes remaining.
Has 3 minutes remaining?
3 minutes.
Gentleman from, I yield to the gentleman from Wisconsin.
Gentleman's recognized 3 minutes.
Mr. Chairman, this is remarkable. My friends across the aisle actually include and vote for a review process of the CFPB. And now they come in today and say, listen, we want to do away with that review process. I mean, how last year did we come into this House and say we're going to vote for a review process of harmful rules coming from the CFPB because it doesn't include the standard of consideration for safety and soundness. But today, with my bill, they come in and say we don't want any review process. That, to me, Mr. Chairman, does not make sense. And I don't think it works for the American people, and it doesn't work for small community banks and credit unions who support a review process. Not only that, but they support a voice in that review process, and that's what my bill does. No, I will not now yield back.
Gentleman yields back his time. The question is on the amendment offered by the gentlelady from Texas. All those in favor say aye. Aye. All those opposed say no. Pin the chair, the noes have it.
I ask for the yeas and nays.
Ask that we have a recorded vote in hopes it'll come out the same way the voice vote really did.
Pursuant to Clause 6 of Rule 18, further proceedings on the amendment of the gentlelady from Texas will be postponed. It is now in order to consider amendment number 3 printed in the House Report 112-172. For what purpose does the gentleman from Oregon seek recognition? Clerk shall designate the amendment.
Amendment number 3, printed in House Report number 112-172, offered by Mr. DeFazio of Oregon.
Pursuant to House Resolution 358, the gentleman from Oregon, Mr. DeFazio, and a member opposed shall each control 5 minutes. The chair recognizes the gentleman from Oregon. 5 minutes.
Thank you. Hopefully, this will be an amendment which can be accepted. It's quite simple. And what I'm addressing is what the Washington Post has called the revolving door that spins at a dizzying pace here in Washington, D.C. The New York Times has said that Goldman Sachs is government Sachs. For all the employees who bounce back and forth between the nation's capital, the regulatory bodies, administrative branch, and its Manhattan office tower. And all my amendment simply does is prevent potential conflict of interest. Remember, a board here has been created in the original bill which can overturn any regulation. Fairly unique among independent agencies that there's a board which can overturn the administrative procedures or rules that they adopt on the financial services industry. But in any case, that was in the original bill. This bill would reduce from a 2/3 majority to a 50% majority of this 10-member board. And my amendment just says, look, if there are 10 people sitting on the board and it's potentially a close vote, and this is something that's going to affect, say, not to pick on Goldman Sachs, which would say Goldman Sachs, and a member of the board, is a former employee of Goldman Sachs within the last 24 months, that member would have to sit out the vote, plain and simple. It's a conflict of interest rule. I would hope that this would prove to be non-controversial, and with that, I would reserve the balance of my time.
The gentleman reserves his time. The gentlelady from West Virginia, recognized for 5 minutes.
Mr. Chairman, I claim time in opposition.
The gentlelady is recognized for 5 minutes.
Yeah, I'd like to tell the gentleman that I really see what he's getting at here, and I do think that some of his ideas have merit because of the revolving door appearance of, and in reality, probably in some cases, preconceived opinions. But I'm afraid that, and I'm not afraid, I think that if a person is qualified to lead an agency, if a person is qualified to be the Secretary of the Treasurer, Chairman of the Federal Reserve, Director of the CFPB, Chair of the FDIC, Comptroller of the Currency, Chairman of the SEC, and there's 10 members on this board, that we really might be, if we agree to his amendment, we might be narrowing the scope of really talented and qualified people. And I think the vetting process, all these folks have to be nominated and confirmed by the Senate. And I think that any conflicts of interest or possible conflicts of interest could be vetted through the confirmation process. And I think by disqualifying some folks, I think that as I said, I think we might miss some good talent. We might chase away folks that have good ideas and vibrant ideas in the area of finance. So with that, I would oppose the gentleman's amendment.
Would the gentleman yield
yes.
for a second? I think there's some misunderstanding. They can serve on the board. It's just that if a proposal comes up that directly infects their previous employer and they have been on the board less than 2 years, they would have to sit out that particular vote. They can serve and vote on any and every other procedure, but just not on that particular thing. It's a very restrictive conflict of interest rule.
Well, I thank the gentleman's clarification because I didn't address that in my statement, and you're absolutely right. But I would just continue to oppose the gentleman's amendment.
Thanks. I'll
reserve her time or yield back? Does the gentlelady reserve her time or yield back?
I yield back.
Gentlelady yields back. Gentleman from Oregon is recognized.
Well, Mr. Speaker, obviously we've straightened out that misunderstanding that the folks could serve. Now let me just hark back to something where I think many of my Republican colleagues agreed with me. I voted against the TARP bailout. Hank Paulson. As I said at the time, I think he was a Goldman Sachs executive standing in as Secretary of the Treasury and meting out justice to some of his former competitors in terms of who lived and who died on Wall Street. So I would think that there would be agreement on that side that for future conflicts of interest that these people would be restricted only on that one vote, only that affects their former employer, only within the last 24 months. I yield the balance of my time to the gentleman from Massachusetts, Mr.
Well,
President.
I thank them. I first...
About 2.5 minutes.
How much time?
2.5 minutes.
Well, first, the gentleman was gracious. I would just note my disagreement with his statement on Secretary Paulson, but more importantly, I was struck by the fact that the gentleman from West Virginia stood up and opposed the amendment. The gentleman from Oregon, that is for opposing the amendment, was incorrect, whereupon the gentleman from West Virginia said, never mind, but I still oppose it, with a less than eloquent explanation. So I think that's unfortunate, and it's part of my problem. I didn't get a chance to talk fully about this rule. This is a terrible, unfair rule. I asked the chairman of the Rules Committee yesterday if we could have more time to debate. Not all the amendments were of equal importance. We had the very important amendment by the gentleman from Texas to talk about two-thirds versus a majority. This is an important amendment about conflict of interest. We had a very important amendment coming up from the gentlewoman from New York about the powers. It is outrageous that the Rules Committee said you only get 5 minutes on each side on each amendment. And the chairman of the Rules Committee, he's a magnanimous fella. He said to me when I asked him, he said, well, you know what, you can go get a unanimous consent agreement to extend it, which meant he was not suspending the rules of the House. I approached the other side, and I was told not by the chairman, who's been very gracious in all this, but the Republican leadership wanted to hurry this bill up. So we have very fundamental issues not being adequately debated, and this is one of them. I have some differences with the gentleman from Oregon about what I think happened during the TARP, but to have only 10 minutes on this, and then frankly, for the chairman of the subcommittee to be so dismissive of a valid amendment, to say, here's why I'm against it, because her staff apparently didn't read it when they wrote it and they gave it the wrong reason, and then she just said, well, I'm against it because I'm against it. That's an inappropriate way to deal with this serious issue. And it reinforces my view that what we have here is this. Last year, every single Republican opposed an independent consumer agency, in principle. They now come forward with efforts that would substantially weaken it, that everybody who does support it opposes, and they say, oh, no, we're not opposed to it. You're just trying to change it. The gentleman from Oregon has a perfectly reasonable point. I cannot understand, other than simple partisan rigidity, why it would not be accepted. So I thank the gentleman, and I am sorry we do not have a
Gentleman's time has expired.
Civil atmosphere in which
Gentleman's time has expired. The question is on the amendment by the gentleman from Oregon. All those in favor say aye. Aye. All those opposed say no. No. Opinion of the chair, the ayes have it.
That a recorded vote.
Pursuant to Clause 6 of Rule 18, further proceedings on the amendment offered by the gentleman from Oregon will be postponed. It is now in order to consider Amendment Number 4, printed in House Report 112-172. For what purpose does the gentleman from Minnesota seek recognition?
Speaker, I have an amendment to desk.
Clerk shall designate the amendment.
Amendment Number 4, printed in House Report Number 112-172, offered by Mr. Paulson of Minnesota.
Pursuant to House Regulation 358, the gentleman from Minnesota, Mr. Paulson, and a member opposed shall each control 5 minutes. Chair recognizes the gentleman from Minnesota for 5 minutes.
Mr. Speaker, I rise to offer this amendment really to help ensure that we maintain prudent regulation of the financial services industry. Mr. Speaker, under current law, there are 5 non-voting members of the Financial Stability Oversight Council, including a state insurance regulator and a state bank regulator. This amendment really seeks to ensure and only clarify that these regulators and the Financial Stability Oversight Council, who do not have voting rights, still have the authority to challenge any regulations that are brought forward or put forth by the Consumer Financial Protection Bureau. For example, while it's clear that the CFPB does not have the authority to regulate insurance, it could put forth a regulation that actually negatively impacts the industry and the economy. So it just makes sense that all the members on the Council have the ability to consider the impact that these new rules may have. Therefore, by clarifying that any member of the Financial Stability Oversight Council may question any regulation and bring that up for clarification, as well and clarify the rights of the non-voting members, I'm seeking to improve the oversight on the CFPB, and I ask for adoption of the amendment and reserve the balance of my time.
Gentleman reserves the balance of time. The gentleman from Texas.
I rise in opposition to the amendment, and I'd like to yield to 2.5 minutes.
Gentleman is recognized for 2.5 minutes.
Yield 2.5 minutes to the gentleman, Mr. Cummings, and reserve the right to close.
I thank the gentleman for yielding. I rise in opposition to the amendment, and I rise in strong opposition to this bill. This misguided legislation seeks to destroy the Consumer Financial Protection Bureau on its birthday, before it even has time to take its first breath, out of fear that the interests of consumers, our constituents, by the way, may finally have a voice here in Washington. I note that the CFPB is the only federal agency that can have its regulations vetoed by other banking regulators serving on the Financial Stability Oversight Council, and this bill would make that veto process even easier. Among other destructive provisions, H.R. 1315 would exclude the director of the CFPB from serving as a voting member of the FSOC, which would make the director the only banking regulator without a seat on the council. The CFPB is one of the most important creations of Dodd-Frank because it is the very agency focused on ensuring that the consumer protection products made available in the marketplace will not lead to families' destruction and economic ruin. Rather than attacking this agency, which is intended to defend the rights of consumers and protect them from predatory practices, we should be standing with our consumers, with our constituents, and protecting them from financial entities that would take advantage of them. Last week, I convened a forum to examine the abuse that service members are suffering at the hands of mortgage servicers. Thousands of U.S. military service members and their families have lost their homes, been charged millions of dollars illegally, and been subjected to other abuses in violation of federal law. The CFPB was created precisely to help Americans such as these, our constituents. I urge the members of Congress to stand on the side of their constituents by supporting CFPB, and I urge Congress to vote for their constituents and vote against this bill. With that, I yield back to the gentleman.
Gentleman yields back. Gentleman from Minnesota.
Just continue to reserve the balance of my time.
Gentleman reserves. Gentleman from Texas.
I continue to reserve such that I may close.
Gentleman from Minnesota.
Mr. Speaker, we have no more speakers, and I know that the gentleman was speaking earlier in the opposition to the bill, and perhaps there's no opposition to the amendment, but I would yield back the balance of my time.
Gentleman yields back the balance of his time. The gentleman from Texas.
Thank you, Mr. Chairman. Mr. Chairman, this amendment is indicative of why we are in opposition to much of what is being said today. This amendment assumes that there is some sort of onerous regulation or some sort of invidious discrimination that has taken place within the CFPB, when in fact the CFPB has not issued one regulation, not one. And because it has not issued one regulation, one can only assume that much of what is happening today is onerous speculation and invidious prognostication, because there seems to be this notion that this agency is going to be harmful, and it hasn't done one thing. There is this concept of throwing out the baby with the bathwater. Well, there is no bathwater. There is no bathwater to throw out because the baby hasn't done anything. The CFPB has done absolutely nothing, and we are now trying to over-regulate it before it has an opportunity to pass a single regulation. It was not the CFPB that created the crisis. It did not create 327s and 228s. It did not create prepayment penalties that coincide with teaser rates. It did not create negative amortization. It did not create the dastardly yield spread premium, which allowed people to qualify for prime mortgages and be forced into subprime mortgages. The CFPB has done nothing. It is an effort on our part to make sure that many of the onerous actions that took place that caused us to be in the position that we're in, that these actions cannot happen again. I stand in opposition to this amendment. I also stand in opposition to the bill, because the bill would weaken the CFPB to the extent that it can't do what it is intended to do, and that is protect consumers. Somebody, some agency ought to stand there for consumers. This agency is that agency. It's the watchdog. We do not need a watchdog without any bite. Let's keep the bite in the CFPB. Let's make sure that it can protect consumers and make sure that we don't get the products that we had on the market before back on the market. This amendment would allow persons who are on the board who do not have a vote to petition, and in a sense that they would become empowered by this ability to petition, even if it doesn't impact the industry that they happen to represent. I stand in opposition to it. I think the CFPB, as presented, is the best way for us to continue.
Gentleman's time has expired. The question is on the amendment by the gentleman from Minnesota. All those in favor say aye. Aye. All those opposed say no. No. Opinion of the chair, the ayes have it. The amendment is agreed to. It is now in order to consider amendment number 5, printed in House Report 112-172. For what purpose does the gentleman from North Carolina seek recognition?
I have an amendment at the desk.
Clerk will designate the amendment.
Amendment number 5, printed in House Report number 112-172, offered by Mr. Miller of North Carolina.
Pursuant to House Resolution 358, the gentleman from North Carolina, Mr. Miller, and a member opposed shall each control 5 minutes. The gentleman from North Carolina is recognized for 5 minutes.
Thank you, Mr. Chair. It is simply not true that we all here want to protect consumers. We just have an honest agreement about the best way to do it. This bill really cripples the ability of the CFPB to be an effective watchdog for consumers. And the way that it does it, probably the most harmful part of the bill, is the veto power. The greater veto power is the Financial Services Oversight Council, and the way that that council has to exercise that veto. Here is what the CFPB has to do to pass a rule in the first place. First of all, they cannot require any financial institution to do anything. They can't say you have to give people this mortgage or this credit card contract. They can just forbid. They can say you can't use this contract, this mortgage, this credit card contract because this cheats people. They cannot require, they can only forbid. And before they forbid, before they pass a rule that says you can't do that because it cheats people, it abuses people, they have got to consider all the benefits to the consumers that might come from that, as well as to the financial institutions that offer it. They've got to consider whether it really reduces the ability of consumers to get credit, and they've got to consider the effect on the financial institutions, and they've got to consult with all the other regulators whose business it is to make sure that the financial institutions don't go broke. And then they've got to publish it. They've got to let people comment. They've got to build evidence, and if they don't have support for the rule, it can be turned over by a court. But even before it goes to a court, it goes to this panel, this Financial Stability Oversight Council, and it can be vetoed if they decide that it threatens the stability of the financial system, or the safety and soundness of the banking system. This bill changes it and says not just that they can overturn it, but they have to overturn it if it threatens the safety and soundness, in other words, of financial institutions. In other words, if it would make specific banks go broke. Some banks I agree with what the gentleman from Wisconsin has said repeatedly. Most small banks, most credit unions have had honest business practices, but there are some sleazy ones out there, and we saw what they did in the last decade. Under the bill as it is written, if one of those banks come forward and says, unless we can do this sleazy thing, we're going to go out of business, and the Financial Stability Oversight Council has to disallow it if it would put them out of business. Mr. Chairman, some of those banks, some of those sleazy, scuzzy banks need to be out of business. If the only way they can stay in business is by cheating consumers, they should be out of business. But this bill would not allow that to happen. A consumer protection rule could not go into effect if it put specific banks out of business. That's an enormous change, and it cripples the ability of the CFPB to be an effective watchdog for consumers. What this amendment does is if any one of those prudential regulators, those watchdogs are supposed to make sure that the banks don't go broke, is going to challenge any rule of the CFPB, they have got to say exactly how they think it would threaten the safety and soundness of the financial institutions, make a bank go broke, and they've got to say who they are. Who is this rule going to put out of business? Because the American people are entitled to know if this agency, this FSOC, the Financial Stability Oversight Council, is acting on behalf of the American people and on behalf of consumers, or if they are protecting sleazy banks that stay in business, whose whole business model is cheating consumers. I reserve the balance of my time.
The gentleman reserves the time. The gentleman from West Virginia.